Hey everyone, welcome in to another daily editorial here on the KE Report. We'll recap the jobs data and the market's rebound today back to all-time highs for the Dow, Nasdaq, or the S&P, Nasdaq. Not quite the Dow though, and some of the volatility that we continue to see in the commodity sector. We're chatting with Joel Elconin, co-host of the Benzinga Pre-Market Prep Show, also editor of the Pre-Market Prep website. Joel, just a quick recap of that jobs data today. Payroll numbers grew by about 272,000. That's almost 100,000 above the estimate of 180. Private sector contributed a lot to this. The unemployment rate actually rose by 1/10 to 4.0%. We also had wage gains that were a bit stronger than what the estimates were. So overall, this jobs number is being taken as a strong jobs number just by that headline number. I'm sure we can dive underneath the hood, but overall, market reaction on the back of that. Markets were down to start the day, and they've been having money flow in throughout the day. So, Joel, in this environment, strong jobs, at least on the headline, and strong markets, tie it all together for us.
Good afternoon, gentlemen. Thanks for having me. You get into these different scenarios where good news is good news and bad news is good news or bad news is bad news. I think what the initial look was, oh, unemployment going up to 4%. Oh, that's bad. But then you look at the payrolls. I mean, I just think we have to look at where we're at in the entire interest rate cycle. And we're just got to hold steady. The people that have been banking on rates coming in, rates being lower, well, you know what that means? That means the economy's slowing down. And you know what? These numbers are telling us, yeah, the unemployment's still ticking up a little bit, still historically very low, but just that the economy's still moving. The economy is still moving along. People are still making money. Inflation has not been as bad as they thought. It's been coming down. We'll get some more information on that next week. But just what we've been saying all along, that as long as the economy is looking good, I mean, we had a great round of earnings for Q1. It's just hard. If you're going to hit the market because unemployment goes up to 4%, well, you're not really thinking because right there, the payroll data comes out. So to me, it's just stable for longer. Let people that are in fixed income or have money in T-bills, let them make their 4, 5, 6%. People that want to speculate in the market and look for higher returns, that's good. But it's just a trend. The trend is your friend. The trend is up. And the data that we got today did not do anything to really upset the apple cart.
Yeah, well said, Joel. And it seems like there's a constant bid in the market. The market's been hitting new all-time highs and on a regular basis. And it seems like there's just a bid there despite the news to keep pushing it higher. So hard to bet against these markets. Just a question, though. It seems like not only are people betting on the markets, but the speculation is getting a little hotter lately. The two big stories from the last week or two have been Nvidia continuing to scorch higher, now $1 trillion company, getting ready to move before the split here. And then also the meme stocks are back with Roaring Kitty. Do you take those, the Nvidia pile on and the meme stock volatility, as signs that maybe the markets are in a new growth phase here?
Well, there's a couple ways you can look at it. You can look at it as that Nvidia split and the GME is excessive speculation in the markets. And that, historically, that's come at tops in the market. But you're talking about two different stories here with Nvidia having one of the best pre-split moves I've ever seen, probably going back to the Tesla move. But what a lot of people fail to understand, with the rate of increase in their earnings, the amount of money that they're bringing in and increasing quarter to quarter, even with their guidance, that the stock, even when it has these crazy moves off the earnings, it still might be trading at a cheaper multiple than it was the day before. There seems to be an insatiable demand for these chips, and from every perspective, it doesn't look to be slowing down. So looking at that, it's had a big run off the earnings, off the split. I'll just look at this technically. And the way I'm looking at technically, of course, everything's going to be 10 for 1 tomorrow. What I would encourage the longer term investors in this stock, I would take a look at that old time closing high that was made on Wednesday at 1224.40. So that will be 122.40, whatever way you look at it. I tend to put more significance on that than I do that all-time high that was made yesterday at 1255.87 because it traded there momentarily, and that's not where the big boys were marked or the big holders. The big holders were marked at 1224.40, that all-time closing high price. So if they're going to want to get out or trim the position, that could be the area. It didn't quite hit that in today's session. So if you want to sell into a little bit of strength, equate that number on Monday. The number I've been stressing on the downside on my show, and it's really not going back very far. It's not any great genius number. Your low on Wednesday was 1174.68. Your low yesterday, 1183.20, and then today's low is 1180. So I'm looking at that 3-day low. It's not even the low for the week. And things could get a little dicey under that because your actual low for the week is 1120. But if you want to sell into the strength on that, I'm looking at the all-time closing high price. If you want to try and protect some gains here and sell into a little weakness, which no one likes to do, then I'd be keeping a real close eye on the equivalent of Wednesday's low with the 10-for-1 stock split at 1174.68.
So, Joel, just broadly with these markets, are there any correlations you are seeing, either positively or negatively, with any of the other large markets, like currencies, like the bond market, or even like expectations around central bank rate cuts, which we did get a couple this week out of the ECB and Bank of Canada? Any correlations that you're watching that give you a little heads up where the markets are going?
We've decoupled, right? Europe, their economy was never as strong as ours, right? And they did experience the inflation. So I think that there's a little bit more of an incentive for them to, with inflation coming down to, but we're kind of out on an island here with our high-tech companies. I mean, yeah, it's a narrow breadth in the market, but man, we are just out on our own. I don't think I could draw really any parallels. If you want to look at things on a valuation basis, I mean, look, of course, the S&P is trading at a high multiple, but if you're going and buying Chinese stocks like Alibaba or Baidu that are just trading at ridiculously low valuations, you're just getting ridiculously lower prices. So, no, I can't. I think it's really hard to find parallels between what's going on in the United States and just decoupled from the other world economies. How long that will persist, I don't know. But it seems to me we were a really unique situation. We were still be able to grow and expand the economy in a rising interest rate environment. So to answer your question, no, it's hard for me to draw parallels with these other markets.
Well, and Joel, we'll know more next week when the Fed meets, but it doesn't seem like there's any impetus for them right now with everything going pretty well in the economy to really start cutting rates anytime soon, like the Bank of Canada and the ECB had to do. So it may be that we stall off those rate cuts for longer, as you say, just stable for longer. In that kind of an environment, does it take longer for the small caps, let's say in the Russell 2000, to get a bid? Because people came into this year pretty excited about the small caps, but they were anticipating 7 rate cuts. Now that there haven't been rate cuts, does that mean that the small caps continue to underperform?
I had a guest on the show the other day, and we were talking about the small caps and how it's lagging. And his comment was, do we need the small caps? A lot of these are smaller companies, losing companies, not making money. And they need, obviously, you don't need the lower rates. So, I mean, you can keep playing the catch-up trade, but if there's anything that's worth in investing in the last couple of years, is it good? The momentum trade has been a lot better than the catch-up or the value trade. I mean, there's occasional moves in the markets and individual stocks and stuff, but just if you wait for this IWM, it's been in a nice trading range between 200 and 210, but I don't think you're going to get a sustained move until you start to get some rate cuts. And even then, I don't know. It just seems that the narrow breadth, you just have to go what's been working. And right now it's been your Microsofts, your Apples, Nvidia, Google, Amazon, Meta. The strong get stronger, and it just seems like the weak get weaker or don't really improve.
So, Joel, to your point about the momentum trade, let's shift focus over to commodities. We can break them down one by one, where gold had a lot of momentum to the upside over the last, let's say, month. Maybe it's been more sideways. Silver, that had momentum to the upside, and now it just has momentum in terms of volatility every single day. Crude, that's been stuck in a range. Copper had momentum to the upside, but then that also faded recently. How do you see momentum in any of the commodities?
Oh man, silver's crazy. They have their runs and then the rate comes into play. So if you play the volatility, I'm looking at the gold chart here. Big red bar today. Usually one red bar produces another red bar. I think I would just look at the $2,300 level in that and then stay trying to catch a solid bid over 2,400. But they both had some big runs. They're both having pullbacks. It just doesn't seem like the momentum with you got to sell when it's going up and you don't think it's ever going down. And then when they have these down days, you got to just be brave and stick your nose out there. Quitting to the $2,300 level in gold. Silver has a trio of lows at the 29.40, 29.50 area. That's currently where we're trading right now. But as I said before, usually one big red bar on a daily tilts some momentum going the same way. And overall, with commodities, I mean, where's the inflation? I mean, copper had a big run based on a bunch of different economic factors. Copper's pulled back, crude is pulled back substantially. So we'll get more on the inflation numbers, but crude's a big part of it. The copper, it just seems like neither runaway inflation is here nor rapidly falling rates. This is a stable interest rate environment, and this is where it's going to be for a while, and you have to fit your long-term investing into that thesis.
Well, Joel, just to that point, do you think we're kind of in a Goldilocks zone here where earnings were pretty good, as you pointed out? Oil and gas coming down is good. That removes kind of a tax on the consumer and the business because energy is a huge part of that. Inflation doesn't seem to be running wild or anything. We'll get more information next week, but nobody's expecting a big blowout number. So are we in a Goldilocks zone here for the market?
Yes, we are. We are absolutely in a Goldilocks scenario where buy the dip in good, strong stocks at reasonable valuations. It's still the mantra that's working. You just got through an earnings season. You have your inflation numbers, but it's like, what could go wrong, right? Those are times where you could try and pick tops in the market, but in the long term, the history of the market is to move higher. I think you're in that current environment right now, and heading into you have an election, you have a lot of uncertainty on the geopolitical front. The market doesn't care about the war in Ukraine. They don't care about the war in Israel and Gaza. I mean, it's a rare time in the market. And instead of trying to figure out when it's going down or when it's going to turn, you just got to ride the momentum. It's one thing I always say to you guys, where are you at in your investing horizon? Are young guys like you? Yeah, you got to still be putting money into the market. If you're an old guy like me or even older, where you're at, when do you want to retire? What are your invested objectives? So it's really where you're at in your investment horizon. Do you want to buy a new house? Kids going to college? I mean, there's time to ring for good purposes. The trend is your friend right here. And when there's no resistance in the market, you'd be a fool to try and find resistance.
Enough said, Joel. Great point to end on. One thing to consider, S&P has been up, I think, 7 of the last 8 months, and that was even a year after the markets truly bottomed and were up consistently before that. So these have been strong markets. Momentum has been your friend to the upside, and as much as some people want to fight it, boy, oh boy, you've missed out on some very impressive gains. But in all fairness, there's been a lot of markets that have been moving higher as well. So it's been a great environment to be invested overall. Plus, if you don't want to be invested, you can still get 5% on your money. That's not a bad scenario either. Joel, thank you very much for your time. Always great chatting with you. We'll chat next week. Have a great rest of your week.
Okay, thank you, gentlemen.